What if I told you there's a hidden gold mine most entrepreneurs never see? You see, 96% of companies never hit $1 million in revenue. But what if you could skip all of that, including that startup grind, and buy a business that's already making money? See, in the next 5 years, $10 trillion in business value is about to change hands. Most people have no idea. So in this episode, we're talking about a strategy that can turn ordinary people into business owners seemingly overnight. No venture capital, no endless fundraising, just pure strategy around private equity acquisition. You see, this isn't about luck. It's about a proven system that has the potential to transform your financial future in a matter of months, not decades. One conversation, millions in potential. Are you ready to learn how? Most people think they need millions to start, and I'm about to show you how wrong they are. Let's dive in and discover a roadmap to entrepreneurial success from the master himself. Here we go. Hey, welcome to another episode of Making Billions. I'm your host, Ryan Miller, and today I have my dear friend, Walker Deibel. Walker is the Wall Street Journal, USA Today bestselling author of Buy Then Build and the founder of Acquisition Lab. He also leads the elite acquisition accelerator who has helped entrepreneurs acquire over, get this, $400 million in private equity acquisitions. He's an entrepreneur and an investor who has co-founded 3 startups, acquired 8 companies outright, and has consulted inside over 100 business transactions. His work has been featured in Forbes, Entrepreneur, Inc., Fast Company, and the Harvard Business Review. So what does this mean? Well, it means that Walker understands how to buy and build companies, and he's about to teach you a masterclass on how to do the same. So Walker, welcome to the show, man.
Ryan, it is such a pleasure to finally be here with you. Right before we went live here today, I actually looked back on Instagram. I'm following 39 people on Instagram. I'm not super active, but it was listening to this podcast that I was like, I need to find Ryan Miller. And so when I found you on Instagram, we actually met on Instagram, and it was all because of this podcast. So to be here on Making Billions is just, it's a dream come true. And, just getting to know you along the way has been nothing short of a pleasure. And for any listener out there who's like, I wonder if Ryan is really this cool. He is, just so you know. He's this cool, and he's this talented, and he's this hungry for information. It's great. Thanks for having me, is the point. Yeah,
you're welcome, man. We were so fortunate, and the feeling's mutual, man. Your book, Buy Then Build, and everything you've done. I know you're known for that, but you're known for a lot of other stuff too. You've helped hundreds of entrepreneurs. You're buying companies, you're transacting in hundreds of millions, so that number keeps going higher. And you're getting after it like I am, man. And you just want to add value, so I think the compliment goes to you. But that being said, we're going to talk a lot about buying and building companies. So as I like to say, entrepreneurship through acquisition. So there's a lot that goes into it, but I'm just curious, how did you get into this industry? Maybe walk me through a little bit of how that got started, and we can go from there.
My origin story is actually, it's not something that I lead with ever. Okay. And the deal is, look, it went like this. I was trying to be a startup entrepreneur, right? And I was starting businesses and they kept failing. And, I lived out in the Bay Area for a while, and I did the whole thing. And, when I was at Olin, we were in a business plan competition, all the things, right? And it just failed and failed and failed. And it's like, it's okay, because we know when we're trying to start a business that it's statistically it's going to zero anyway, right? I mean, it's just very few actually make it. And it was one of these, Ryan, where my most recent startup had failed. I live in St. Louis, Missouri. I was getting my MBA at Olin School of Business here. And I was walking up and down Wydown Boulevard, which is sort of the only boulevard in St. Louis. And I'm walking around where the neighborhood over from the top 10 richest neighborhood in the country. And I'm looking at all these Home Alone style houses. And I'm just thinking to myself, you know what? None of these people are a e-com entrepreneur or a software Silicon Valley. And they're just doing light fixtures and paper and just unsexy things that cash flow. And I was like, I know there's going to be a way to acquire one of these, and I think I can just get the money from the bank. And so I set out to do that. 2 years later, I still had not been able to pull a deal together for a number of reasons that were subsequently solved. But what happened was my dad owned a book printing company. And he sat me down and said, Walker, I want you to leave your high-paying job and come to work for me. And I was like, why? And he stood up and he said, well, let's just see if you show up for work first. And he left. I ultimately bought his company, and it sort of went like this. We got a third-party valuation. I took a personally guaranteed loan that was multiples of my net worth. I put skin in the game in terms of a huge portion of all the cash I had in the world, and I gave it to him, and then he left. That's what went down, right? But I was in this small group of people that had a situation where like their father owned a small business. And that's when all of my entrepreneurial friends were like, hey, it took a couple of years. This is Walker. He buys and sells companies. And I just remember thinking like, you guys don't get it. Like I'm in the Coliseum with you. What I'm doing is entrepreneurship. It's just that my revenue is so much bigger than yours. You know what I mean? And so like, I was like, how do I get this message out and try to explain to people that entrepreneur is not just, a ground up 0 to 1 practice. It's also, the buy then build model, buying existing companies and growing them.
Good. Wow. That I did not know that. So there's this constant battle between going vertical versus horizontal.
Yeah. Yeah.
And I remember you telling me a little bit of story in the early days when you started out that you chose one direction and you kind of figured it out soon that maybe there was a better way. Can you walk me through a little bit?
I know where you're going. I was a keynote last week at a conference where everyone is jumping in being like, I read Buy Then Build. I want to buy all these companies. I'm going to close on 17 this quarter. And I'm just like, oh my God. Like, here's the deal, Ryan, like the worst decision I ever made was to start a holding company, right? I bought 7 companies. I went horizontal. I was like, I'm going to be the Warren Buffett of small business. I'm going to acquire that you've never heard of. I'm going to acquire all these little businesses and I'm going to own 80 to 100% of them outright. And I'm just going to take as much debt as I can. And I'm going to buy in all these different verticals and have this, diversified portfolio of all of this stuff. And what I realized was, even though my companies were acquiring other companies and all the rest of it, at the end of the day, look, I always like to quote, if you go watch like Print the Legend, it was the second ever Netflix original. It starts with Brad Feld, like this iconoclastic startup entrepreneur. And he says right at the beginning, when you're a leader, when you're a CEO, every day something comes up and smacks you in the face. Ryan, when I talk to entrepreneurs and I'm like, hey, like how much do you work on your business? They're like 80 hours. And I'm like, great. Do you want another 12 businesses? And they just laugh. It's like, no, dude, like even Steve Jobs needed one. Like he didn't need a bunch. What I learned was, I was getting smacked in the face in 3 different verticals every day. Like it was like different management teams, different customer profiles, different cash flow cycles, different value propositions, different culture, different, all the things. And so it's like, what happened was I realized it's not really diversified at all. You're actually stacking risk, and things that aren't actually correlated become correlated to each other in terms of things that could hang you up, right? So for example, when I had a big customer, like my number one customer at my distribution company needed me over there because like shit's going down over here, so I'm over there. Meanwhile, in New York, whatever, right? So it's like you've got to deal with like the drama and the supply chain and the cash and the stuff, and you got to be pushing everything forward all the time. And what I realized was, what's the saying? He who chases 2 rabbits catches none. Yeah. It was a lot of that. And I learned a lot of lessons from it. And I do think that there are proper ways to sort of engineer success in that model. The thing that I really preach when people want to get into acquisition entrepreneurship is like, dude, guys, buy one, focus on one. I ran that printing company for 7 years. I sold it to an acquisition target who decided he wanted to buy me in the thing, in the deal. And I was like, great. I took the proceeds and I went out and I bought 6 more companies. And that's when I got into trouble, right? It was all about one at a time.
Man, what a story. So I've got so many questions, but we'll throttle it down a little bit.
Well, hold on. To think about, what if I had bought all 8 companies in one vertical? Like you would have gotten the multiple expansion, like the value, you would have turned the flywheel, the culture would have been the same. Everything falls in line. And then size begins to really matter because you're talking about the multiples of higher cash flowing businesses are higher multiples, right? And so, I could have gone public. You know what I'm saying? Yeah. Sorry to interrupt.
No, you're great. And there is a saying from my good friend, Ben Reinberg. He was just on the show a few weeks back, and he manages Alliance CGC, about 500 million real estate fund. And he always says it, and I've adopted it. He's living rent free in my head. So if you're listening, Ben, thank you for this. But he said in business, especially in investing, like the sector we're in alternative assets, you get rewarded for focus. And I think what you're saying is that fractured my focus. One of my most valuable assets is someone at the helm of the holdco. I'm assuming you're saying the holdco wasn't the problem. It's what I filled it with. The correlation between these, they didn't work. And so I had 10 targets and 3 arrows, maybe. And I needed the opposite. I needed 3 targets and 10 arrows that I could just slice through all of them. I can shoot 1 arrow and go through 10 targets. And so I think what you're saying and what Ben's saying and what I'm saying, all of us are saying is like, if you really want to reap the rewards in this sector, think in terms of focus, right? Just like Confucius, right? You chase 2 rabbits, you catch none. We get rewarded for focus. Is that what you're saying?
Yeah, exactly. Nailed it.
Awesome. So how do you get into this industry then? So there's people listening to the show. I know I got students who are in 100 countries. Some people are in grad school. Some are in high school, if you can believe it. Everybody wants to know, PE is hot. You're one of the legends in the space. How do people even start? Like, how do you get started in PE?
Yeah. I mean, I think that, first trying to I think what I would offer is, if you go to, Harvard Business School right now and you talk to the graduate students and you say, what do you want to do? Okay. The number one desired, job at this moment at Harvard Business School is an independent sponsor. Okay. Meaning I want to start a private equity firm with no money and leverage other people's money and buy multiple businesses. Okay. I want to be very clear that, this concept has gotten really popular because it's awesome. It's what you and I do. Okay. It's awesome.
Yeah.
But, and I guess this is going to sound egotistical now. I put myself in a corner, but it's one of these, that's like saying my career plan is to move to Hollywood and become an A-list actor, right? Like you can't just do, that's not out in your control. So there's sort of two paths that I think about. And the first one is look, you're at Harvard, go to New York, go to Wall Street, get into private equity, go the financial route, get that, job at Goldman and do whatever you need to do for a decade and just grind out your 20s and opportunities happen. Build a resume, go the right direction. The other way is, I think acquisition entrepreneurship and small business ownership is really the only way. It's really the fastest way for most people to make any real money. And I don't mean that to sound that it's fast. It's faster than anything else. And it's also very approachable, right? So in other words, when you buy an appreciating thing that cash flows, that you can put your time, effort, and money in, guess what? It goes up, usually, unless you mess it up, right? So you can go out and, acquire one of the largest companies in the world for $100,000 out of pocket. It's not a lot of money. And, when I was with Entrepreneurs Organization and I read a lot of Vern Harnish's work, that's when I realized 4% of companies reach $1 million in revenue, top line revenue. 96% of all those startup companies never hit $1 million in revenue. Who would start a company if they knew that, really, right? So it's such a low bar to be so exceptional, right? And it's very much approachable to, get a bank loan, put a little bit of cash in, and just start to grind in your own business. And when you're buying a small business as an operator, you're learning how to operate businesses. You learn all the BS, right? Your actual boots on the ground. You're going to learn leadership. You learn all the things that actually make business function. And not only that, but when you're buying small businesses, guess what we call that? Private equity. That's what it is. Okay. It just is a different asset class than what we think of when we think of what the boys on Wall Street are doing.
Brilliant. Yeah. So, you've been accredited from a lot of people. I won't say any names, but some people who have beards and big muscles. Another certain bright lady who buys laundromats and all that. And they're very well known in the industry. But I was pleasantly surprised, but I don't know why I was surprised when I found out that the one thing they had in common was you. And your work inspired people who are now inspiring other people. So you're the papa of the private equity. So
all roads lead to buy then build, Ryan.
There you go. Yeah, I'm finding that. Yeah, agreed. And I even have your book on my bookcase behind me. And so when it really comes down to it, right? So I would love to just open up some of the stuff that very influential people today in private equity are kind of putting their own spin on. But I want to go back to the source material. So when it comes down to going into private equity, so let's say you're the syndicator, right? Well, actually, this the guy who goes pro, same thing. Either way, you got to get your start. So where do you start when it comes to you want to buy your first company or your 10th? What's a good place to start?
I think that what you really need to understand, this is so funny. Yesterday, I was talking with the CEO of the best performing coding academy in the history of the world. They gauge themselves on, graduates employed after 30 days and average starting salary. And it's the best program that's ever existed. And I was talking to him and he's been running it for about 9 years. He said, Walker, what's funny? I said, what? He said, I got into coding because I felt like it was the little thing that helped people expand into, expand their careers and reach new heights and make real money. And over the last 9 years, that sort of shifted into AI. So now we're running cohorts on helping, engineers develop AI. But I'm noticing this trend, and that's that a lot of my developers are now at a point where they're sort of bored of writing software, and they're actually going out and they're buying these old economy, unsexy businesses. And I was like, well, come on, man. And he was like, I know you've been talking about it the whole time, but I'm just figuring it out. And then he went on to talk about the silver tsunami. And I'm like, why are you telling me about silver tsunami? Like, the point is that baby boomers own more businesses than any generation in the history of mankind. Okay. And now they're just retiring in droves. It's like 11,000 a day are retiring. Okay. Here's the thing. We'll get into this, I'm sure. But like the SB, like changes in the SBA have also made this very, very approachable in terms of being able to access debt in ways that I couldn't 20 years ago. Right. And so what's happening is no one has said, why the federal government is providing massive amounts of debt loans to Americans that just want to acquire small businesses. I think it's because when you look at the numbers, it's like 46% of the entire US economy is in these baby boomer owned businesses that wouldn't otherwise transfer, right? So it's like we think of, private equity as this like whatever, 100 million and up kind of deals, right? That's like the smallest little tip of the pyramid. And then you have like 96% of companies that are like under $1 million, right? So so you really have, whatever the number is, it's like 3.5% of companies are like between like 1 million and like 25 million, right? You've got a huge volume of businesses that have, the kids don't want it. The owners, they're driving around in their Lexus, they're just making money. There's no more debt. They don't really want to invest in it. And so you have to understand the fact that there's $10 trillion in business value that needs to change hands in the next 5 years. It's absolutely massive, right? And so just to pull it around, the CEO of this coding academy had figured out, this sort of trend or the opportunity that's happening right now. And he was like, hey, I really want to talk to you about talking with our AI developers, because I think that if we plug in AI to a lot of these old economy businesses, this is an even greater sort of lever that these guys can use to like build exceptional wealth and impact for themselves, because he understood the opportunity. Does that make sense?
Yeah, absolutely. So, sounds like then that step one really is just appreciate the opportunity that's at your feet right now.
That's it. It's right now.
It's right now. And once you really appreciate that, and you mentioned earlier that I can't remember the percentage in the 90s that make it $1 million or less. What was that percent in revenue?
It's 96% of companies never achieve $1 million in revenue.
Okay, so that's perfect for people who are starting out, because it's like, you've said this to me before offline, but you're like, the bar feels high because all you see is like these mega deals, like Oracle bought this or Apple or Meta bought that. And you're like, oh my gosh, how could I be that? I'm just Ryan or Walker or Sally or whatever. And what you're saying is, look, 98% of the businesses out there are like $1 million or less, man. So it's super possible. Even if you're starting out, you don't need to be a zillionaire. You can actually start out and find one of these small companies. I mean, obviously do your homework, talk to your lawyers and all that. We're not giving any advice, but what we're saying is the field's ripe, ready to harvest. Like it's there.
And Ryan, if you don't mind me jumping in, I just want to, just for clarity, like the way that I think about it, and this isn't right for everybody, but the way I think about it is, don't buy a business that's less than $1 million in revenue. Buy one that already has achieved that. Don't you see? Because it's like they're one that has found that product market fit. So like if you buy a company that's 600,000 in revenue, like there's not going to be enough money to pay yourself. Like it's going to be that's hard. But like like I know people that have bought a company for like 650,000 in revenue and taken it to 25 million in 24 months. It happens. People also win the lottery. People also get struck by lightning. Like all these things happen. You know what I mean? But it's like, I think that if you look at a business that's, between like $1 and $5 million, like that's something that you can get in very, very easily. And it's already got that product market fit. And it's sort of like the money ball of entrepreneurship. It's like I'm already getting on first base, right? I'm not swinging at the ball trying to get home run. I'm just getting on base. And then I'll take it from there. Right.
Yeah. And you bring up a good point, because I was that way, because you kind of get pumped with case studies in grad school and all these big things. And so you think big
totally
from school, and that's okay. There's a place for that. There's a place to play big. But what I had to learn outside of school is to when to think small. And by small, it doesn't mean not ambitious. It means intelligent. And so it's like, sure. And so I felt stuck, because I was like, yeah, put me on $100 billion deal. I will make a spreadsheet that is like a work of art. Ask me to price out this $2 million deal. I was like, I don't know, where do I even start?
Yeah,
and
exactly.
You know what I mean? And so I think what you've done for the economy and everybody that follows you, and there's a lot, I think you've shown people a really good real world approach that says, look, maybe you know how to analyze and build spreadsheets at that level, but there is a even bigger market, some would say, below that level. at very reasonable places where you can start. And that's because of what you mentioned and that friend that talked to you about the silver tsunami. Anything to add to that?
So I think that, ultimately, look, when I started writing Buy Then Build, okay, it was one of these where my initial idea, Ryan, was to go out and sort of write like the good to great of this area, right? Like I wanted, like, I was like, no, like I'd been buying businesses at this point for like 15 years. No one was talking about it. No one understood what I was doing. And it was like, okay, I'm going to start by getting a statistically significant amount of interviews and just get started. So I lined up 35 people that had bought companies and started talking to them. And I figured I learned, two things. One, Jim Collins has like 27 PhDs on staff and a ton of data. Two, I lucked out because what I realized was that this space has nothing to do with best practices. And no matter how much, by the way, that people say it is, like they're selling you something, like it has more to do with frameworks. Like you just need to understand what is it that I'm looking at. Right. And like, what's the opportunity that I'm looking at? And so, when you read Buy Then Build, I ended up with this like 4-quadrant matrix because I have an MBA. I needed to have a 4-quadrant matrix. I'm just kidding. But like, it's really sort of like value and growth, right? Is really what it is. And so, you've got this eternally profitable option. You've got this turnaround option. You have this high growth option. You have a platform option. Okay. And the thing is that like, when I talk about platform, I don't really talk about it in terms of like, a roll-up strategy that, a firm might have. Like, hey, I'm going to buy the first one and that's going to be my platform. Instead, I want it to be a platform for the buyer, for you. Okay. And the reason why is because a lot of people will sit there and, as you say, like they look at their spreadsheet and they really spend a lot of time trying to de-risk the acquisition because it's risky. It's like I'm buying one concentrated thing, right? With like a lot of money and a lot of debt and PGs and all the rest of it. And it's like, I can't mess this up, and they freak out. Well, the truth is that the minute you buy that company, there's one thing that's different. You just cut the head off of the business and inserted your own head.
Yeah.
So, when we think about raising capital as like a startup entrepreneur, it's like, hey, where can I get smart money? Like, where can I get that investor that can also just like roll me into Walmart or whatever, because that's the magic, right? And it's the same here. How are you smart money? What do you bring to the table? That business needs to be a platform for you and your own, magic sauce. You know what I'm saying? Like whatever it is you bring to the table. And so as long as people can start to think about like, hey, do I have the right attitude for sort of like being driven in vague circumstances? What do I want my life to look like? And ultimately, what am I good at and what do I love to do? It has nothing to, people always make this mistake where it's like, oh, I'm looking for, a manufacturing business, right? Or whatever, brokers will talk to you and be like, what is your background? Like they're trying to line it up like it's a career, and it's not. It's the soft skill. It's like, yeah, I was in manufacturing, but really I was the sales guy that ran the sales team or whatever. And like, I know how to build sales teams and drive it. Great. You need a small business with tight operations and like good accounting so that you can go out and just like grow it and scale it with your efforts, right? The opposite is also true. Hey, I'm good in operations and in squeezing out profits, just building lean operations. Great. You need something where there's not a sales problem, and it provides an opportunity for you to go in there and just like squeeze all the pennies out of the dollar, right? I mean, all these types of things come into consideration. I think a lot of times people think to themselves, hey, I'm in this industry, and so this is going to transfer. And I just like to challenge them and say, let's really get into it. What is it that you have, right? And ultimately, what do you say? Reputation,
relationships,
right? Relationships and results. If you provided results for people you worked with, then maybe those relationships will matter, especially if they're distributors or, customer relationships or people that can move the needle on the business that you're ultimately going to acquire.
And it also pumps your reputation with them as well. So they're all connected. Like you screw up one, you screw up all. You nail it on one, you're going to help all of it. So you're a guy who produces results. People are going to want to hang out with you. They're going to trust you with a good reputation or whatever it is. And so those three things, I think that's the stuff you don't learn in grad school. That's the stuff you learn just doing deals. If you're a deals guy like Walker and I, eventually you kind of be like, you know what? This is not as complicated. Doesn't mean it's easy, but it's not as complicated as I thought it once was. So now if you're emphasizing reputation, relationships, and results, I take those three as a Venn diagram. I too have frameworks, Walker. So with that, then you surround those three with a fourth R, which is rituals.
Whoa.
So what are, there you go. So mind blowing. Yeah. There you go. Mm-hmm. So what are your rituals or habits around those? And those will reinforce or collapse your reputation, your relationships, and your results if you got the wrong rituals. And so rituals are that reinforcement mechanism to say, are you doing this on purpose, or are you just trying to stumble into the office of somebody that manages $15 billion? Or do you have rituals where you're constantly maybe going to the right events or making the certain phone call? Whatever it is, I'm not telling you do this and don't do that. What I'm telling you is to think about it. What are your habits? Some of them may not be great. Not you, Walker, but maybe sure you. Yeah. But in general, what are the habits? And I've thought about this. You can do an audit and figuring out those habits or those rituals and how do they contribute to my reputation, right? Maybe you have a habit of lying. Okay, not a great ritual for a reputation if you want to be known as having integrity. So whatever those are, figure out your rituals and reinforce your reputation, relationships, and results. And then just eventually you're going to find investors and deals. They're going to come to you to be like, just like they do for you, Walker, is just say, you know what, this guy's super legit. Like he's written books, he's an honest guy, so on and so on. And it's like, I'd love to do a deal with him.
I love that. Can I piggyback on that and sort of flip in another version of what I was describing? Because I think that
absolutely, I'm here to hear. We're here to hear from you, brother.
Look, I mean, like your audience is a very sophisticated, driven, active group of people, and a lot of them have a lot of money, and a lot of them are just very ambitious.
Yeah.
And what I would say to that is, look, like I have a good friend of mine is in a family office that, he's of the family and all the rest of it. He went out and bought a small company with the family office money, and ultimately he runs it in exactly the way that I just described. And so he's wanting to go through as an operator. There's other options. There's other flavors of this same game, and I think, when it comes into going back to that concept of the independent sponsor, at the end of the day, I mean, if you're the person that can raise capital for the people wanting to buy companies, my recommendation would be like, just make sure you start with a good deal. And like, what is that good deal? It's simply identifying who that operator is with that business, right? And then basically putting skin in the game yourself, in my opinion. I mean, I wouldn't invest in anyone, and then ultimately that company, now you're marrying those two things together. And now all of a sudden you're sort of the deal guy, the capital guy, the syndicator, and you're beginning to build that resume towards, becoming that independent sponsor or that deal guy in private equity. Just another flavor that someone out there might say like, yeah, that's what I want to do.
Yeah, absolutely. I love that, man. This is great chopping it up. I'm curious, have you seen people when they enter in this industry, is it a good idea to go alone? Is it a bad idea? Is it possible to do it? I mean, where do you stand on that? What would you recommend?
Sure. Well, okay, there's a couple of ways to answer this. I mean, the first thing I would say is the reason I built Acquisition Lab is because everyone is trying to do this like isolated in their kitchen, and they're trying to make one of the most important critical financial decisions of their life. And I was like, okay, how do we build world-class education? How do we vet a community? How do we give people the tools and, mentors that they need to actually succeed? And that's what has made Acquisition Lab have such elite results. Okay. So, and it's, it's like it's less than like 2 months of a buy-side advisor. It's very affordable. There's no hidden, we don't make money over here or over there or anything like that. It's just clean. Okay. It's an education company at its core, a community at its core. So I'm bringing that up because I built it, and I'm sorry if that sounds like a pitch. It's just, I have to mention it because I did. So on the one hand, if you're looking to do this, like get around people that have done it before, right? Period. Like you are going to spend so much time recreating this wheel, and it's a different animal than anything you've ever seen if you're not familiar with it. Even like we have people in the lab that, they've acquired multiple $50 million companies, and they come to the lab because they're like, I don't understand this small business thing, like sub $25 million space. Great. So I got a guy who took 3 companies public in the lab. You know what I'm saying? Like, it's like, great, let's go. So one example. The other is you might be talking about, should I buy by myself or buy with a partner, right? And statistically, I can tell you that, there's a bunch of information that comes out of Stanford that actually suggests the empirical evidence suggests that if you go in with a partner, you're actually more likely to succeed. Okay. And that's interesting to think about. Now, I was also an EO for like 5 years, and I will tell you that EO is really just a group of entrepreneurs with business partners that need counseling, right? so it goes both ways. But, so if you're going to have a partner, make sure you have a partner that has a different skill set, right? In my opinion, someone's got to own 51% or more. It should not be 50-50. That is rookie mistake 101.
Yeah.
Someone's got to have that lever to be like, we're not talking about this anymore. And then different skill sets, obviously good working relationship. Someone has to have that end control tiebreaker. And the big secret is that you get to buy a bigger business, because what's happening is both of you now can get access to capital.
Sure.
$5 million limit with the SBA, for example. So now if there's 2 of you, you can go in and pick up a business doing $2 million in, adjusted EBITDA. And now you got 2 people in there pushing, right? So I think that was sort of a big surprise that I've learned over the last 4 years was the data that came out around having a partner. Look, I mean, I've done the whole thing by myself. And when I say that, I mean, yes, with my sweat and drive and cash and, risk and all the rest of it. But obviously, I'm also talking about the hundreds of employees that I've had as well, that we all come to work and we all do it together. It's just that, at the end of the day, most people don't own the company and own the equity.
Got it. So do it with a partner is better. And if they need guidance, acquisition lab.
Yeah.
Mm-hmm.
Sorry to interrupt. Yeah.
No, you're good. So do it with a partner. That's what you're saying. And statistically, if you do it, you have a higher probability of success. And as I joke, I'm like, finance is more statistics than it is calculus, right? We deal with probabilities and risks. There's not a lot of absolutes. There are, but I always joke that, hey, if you're good at calculus, go into accounting. If you're good at statistics, go into finance. So we deal with less than 100% a lot of the time. And so the statistics add up that a partner does better, or at least get some guidance from acquisition lab, whatever that is. But just don't wing it. I think it was Vince Lombardi that said the man at the top of the mountain didn't fall there. There's some intention that needs to go into this. Don't try to be lucky and fall on the mountain of cash. It's like you're going to need to surround yourself with a lot of smart people. Back to the relationships. And so whether that's official mentoring or you have an experienced guy that's willing to spend a lot of their next 5 years.
Yeah. Can I just give you an example?
Yeah.
Right. Like I've got a couple of people who bought companies, like they looked at the lab and were like, I can do it on my own. And they bought companies and, one of them, she's an advisor at the lab now. She's gone on and done other things. And she's like, if I had just joined the lab, I wouldn't have made a mistake. Right. Like a lot of people are like, oh yeah, I'm going to buy a quality of earnings. And then I know for sure everything's good. But it's one of these things where Lucas Phillips, I just got back from New York where I shot a video with him. He's in the lab. He's one of my star members because he crushed. He came in every day, was posting in Slack, like all of his metrics. He buys this company and, he bought the quality of earnings. He did like all the diligence things and like whatever. And he gets in there and he realizes that the small business owner, the seller, was a small business owner. And he was just sort of like, ugh, and he was holding the whole thing up and no one was coming to work. And the only guy that had all the IP in his brain was drunk and wouldn't show up. And I mean, Lucas called me like in fetal position on the floor. And I was like, bro, this was a tough love kind of situation. I'm like, the only way is through. You can do this, one foot in front of the other. What's the point? The point is that the answer to everything he needed to know was literally right in the middle of the entire building was all of the time cards on the wall. If he had looked at the time cards, he would have seen no one was actually working 40 hours a week. Everyone was rolling in, working half days. And the seller was the one that was like, well, it's my company. I'll just do all the work and make it happen. Right. And so it's like these little lessons add up and they're all in one place in certain places. Right.
Yeah, that's a really great story. It reminds me, it's a cautionary tale that I learned. So in a former life, I was brought in as a CFO of an insurance company and they were getting ready to sell. And so we call it window dressing, just get it ready, clean up the books, get the numbers, get process maps. And so it was a lot. It was a lot of fun. It was a lot of work, but it was a lot of fun. And one of the things, and I would say, just from my experience, if there are people who want to do entrepreneurship through acquisition, time cards, and also if I can add to that, I call them phantom costs, right? So these are the things that are really costing the company a lot of money, but they don't show up on the income statement or the balance sheet. But, if you're an accountant, you're like, what? Everything needs to be in the income statement. Well, you could argue indirectly they may show up in like lack of revenue or bloat in labor costs. Sure. And they did. And so one of the things to think about is just those phantom costs, right? So the time cards, how much are people working? Another phantom cost are people taking 2 to 3 or 4 hour lunch breaks, right? That costs the company money and it doesn't show up on the income statement, but it kind of does. And so this is where now that might be good for you if you're buying companies like that, because you're like, this company should be worth a lot more. It's not very well led. Often you will find some brilliance through a lot of those phantom costs, right? Poor productivity doesn't show up. Turnover doesn't show up. And of course, time cards. So you're saying, and typically the outcome in productivity and people on those phantom costs, it just shows up in a bloated labor budget. So you're like, wow, 60% of your OPEX is labor? What if we were more productive? That might put it down to 45. I don't know. And so I think that's a brilliant story, and tip of the hat to your friend Lucas for making it through after the fetal position.
Oh, he bought 3 more companies, tucked them all in. He's crushing. He has all the IP of the whole industry now. I mean, it's just like, I'm like, yes.
Yeah. So those phantom costs, man. And once you understand that, now you've got an edge as I would say, just from my opinion, you've got an edge as someone who's buying companies, because now you kind of say, oh, I can see things that most people can't see. Therefore, I see potential that I could turn this around. And phantom costs are like easy to turn around. It's just leadership. It's policies. It's just getting your house in order. But when you do that, watch your valuation soar. There's things start clicking into place. It's not the silver bullet, but it's pretty damn close.
One trend I'm seeing right now, and I'm not saying that this is a massive amount, but I'm seeing it, which is I see a lot of multifamily real estate syndicators moving into the buying businesses space.
Ooh, yeah, let's talk about that.
Well, it's one of these where, raising for multifamily right now is like the hardest time ever. It's like harder than the Great Recession or whatever. It's a hard time. And buying businesses is like what the people want now, right? So it's like everyone ran out and read, buy, then build, right? But the point is like it's sort of like that. It's sort of like that stock picker that's supposed to like stay in their lane, and then like their lane isn't performing, so they walk across the hall while the guy's at lunch and like do some high growth stocks to like boost their like. It's that, like there's a little of that going on. What's the point, Walker? The point is like, yes, running a real estate business is a business, but the way that you grow it is you buy an asset, and then you buy another asset, and then you buy another asset, and then you buy another asset, and it's a hard asset made of bricks and people paying rent. And what I'm seeing is that I don't know that there's a complete connection, that people understand that the value of business is actually in the intangible assets. Everything you just described is intangible. It's a bunch of people coming to work and like doing processes and systems, and sometimes a product comes out of it, or sometimes it's a service that's delivered, right? But like, and at the end of the day, it's just like a melding of intangibles that like there's money going around it somehow.
Yeah.
So we'll see what happens, but just understanding that the value of businesses is in the intangibles, I think is all I'm trying to underscore.
That's a great perspective, man, because again, we like arguably you get some intangibles on your balance sheet, but not all of it, man. And I think that's the point, is to say, yeah, okay, sure. Look at your financials. Absolutely. Do your due diligence, get your accountants, your lawyers, all those people to do that. What we're saying is, what we're talking about, I think, keep me honest here, is we're talking about there's certain things that experience, or listening to the show, or listening to people, or as we said earlier, don't do it alone, do it with someone who's experienced. They could say, hey, have you seen the things that don't show up on the balance sheet? And you're going to say, what? And you say, yeah, there's a lot of stuff that can affect how much we pay or don't pay based on the intangible stuff. And that's what you're saying, is like, you got to look at that and really give it the respect it deserves when you're buying or selling. So, when it comes to buying and selling, there's money involved. So I'm very curious, from your perspective, financing the deal. I mean, what have you seen? What is some real high level advice? Something you and I have talked about before, which is doing a deal with too sharp of a pencil, as I like to call it. Maybe walk me through a little bit of what you're thinking.
Mistake number one. Yeah. Like, okay, this is like, look, I don't want to sound flippant or dumb, but like mistake number one is caring about how much you're paying. And I know that sounds like the dumbest thing. We talked about real estate moving, I make money when I buy, not when I sell. That's a real estate adage. And I don't believe that actually translates to businesses. Real estate is I appreciate it 2% a year and have equity build up model. Businesses is like, how far can you push this thing? It's intangibles. What's the total addressable market, and how much of it can you go get? Right? It's that. And so the thing is like, people are like, okay, Walker, hey, I got this business, but like, they're asking for. In the point here is that the multiples on earnings are very, very low, right? So it's like 3 to 4 times annual earnings, okay, annual cash flow. And so it's like, you compare that to. If you say that to a real estate guy, by the way, what they hear is, what? I can get 35% cap rate, but it's like, it's a different asset, whatever. I'm not going there, but I did. Yeah. Anyway, the point is like, it's such a low valuation anyway, right? Like, what's NVIDIA trading at right now? I mean, it's a crazy example, 59, I don't know, whatever, these tech stock, at the stock market, average price to earnings ratio is like 19. Okay. Like historically, we're talking like 3.5. So people come in and they're like, okay, it's 3.5, Walker, but like, I don't know. I feel like I really just don't want to pay more than like, 3.2 times or whatever. And I'm like, okay, so that's 90 days of earnings. You're going to own it for 10 years or whatever. Are you sure you want to like lose the deal over, I'll pay 3.8 times. I don't care. It doesn't matter because whatever that difference is, it's a 10-year loan that it's going to get paid out over. Okay. Yes. If you get into higher multiples. Look, Ryan, in 2002 to 2004, when I was really trying to figure out how to do this in grad school, the top 3 searches on Google around this space, okay? How to buy a laundromat was number 1, how to buy a car wash was number 2, and how to buy a business with seller financing was number 3. If you want to create a influencer business on buying businesses, those are your 3. Congratulations, go do it. Okay. Now, here's the point. Everyone wants to figure out how to do it on seller financing, but seller financing in the knots was the only way we were able to do things. Okay. There was 3 reasons I bought the book printing company. Yes, my dad invited me, but 2, it's because I couldn't get a deal closed. And when I brought the bank in to look at the big pieces of equipment, they loved it. They're like, there's collateral. Walker, you don't have any money. You don't have any collateral. You want to buy this other manufacturing company that just has aluminum extrusion moving through with some welder guys in it. Like, there's no collateral. These machines are beautiful. And they gave me a loan. And I was like, great. Okay, that was the only way that went down. That other hypothetical example of the aluminum extrusion welding, that's a business I actually own right now, which is why I use it. I couldn't have bought it pre-2016. Here's what happened. I would go to her, the seller, and say like, look, this is small business transactions. I'm going to buy it at a 3 times earnings or whatever, but I don't really have any money. Like, I can't get anything from a bank. Like, there's no collateral anywhere, but I'm a willing buyer. Let's go. I just need we need to work out a seller financing deal. And then they would go, wait a minute. So I'm the bank, and I'm going to give you my business, and then you're going to go run it, and then you're just going to give me the earnings that I would make anyway if I just own the business? That doesn't make any sense. And so deals weren't getting done. Anyone that had a decent business wouldn't sell it because it was just like it didn't make any sense, right? And so ultimately, what the SBA did in 2016 was they solved the seller financing problem. This was actually the year I bought 3 or 4 different companies in 2016. And that was actually the year where I was like, I have to get Buy Then Build Done. It took me 4.5 years to write that book. But I was like, no one understands what just happened. And this was the federal government coming in and saying, if you don't have any money or collateral and the business doesn't have any collateral, we will give you up to $5 million for up to 90% of the total acquisition price. All you need to do is sign this personal guarantee. I was like, give me all of it. So what's the point? The point is I believe that social media has really pushed seller financing. I believe that people wanting to sound smart in the space have been borrowing middle market terminology and deal structure and trying to insert it. No one was talking about working capital pegs and sub $5 million transactions 24 months ago, I promise you. Except for the private equity firms that were coming in that I was then getting my sellers off the phone and educating the private equity firms, like, look, I know what you're doing. I know the middle market. Let me explain how you're working. And like in any situation, in any deal textbook, no matter what, the seller is still getting 3.5 times cash at closing, period. Okay. Don't get hung up in multiple things. If Ryan, people are surprised to hear this. I've never done seller financing once in my life. Not once. I want to write the check. I don't want to owe that person money. I want to download their brain and I want to get them out. I don't want to give them, if you owe someone, 10% of their entire exit of the most valuable thing they own. Okay. If I'm that seller and you're the buyer and you owe me money, I'm going to come up there and I'm going to sniff around the business. I want to know how business is going. I'm going to talk to my old employees. You might catch us whispering. It's just like I'm literally in your business. I like it clean. I want them out of my business, right? And I think that a lot of people think I'm crazy, but especially lenders. But if you really, really look at it, lenders really like seller financing because they can increase their debt service coverage ratio by pushing the seller out, and you wreck your reputation. That's what happens. And now the bank doesn't have to deal with you coming to them being like, hey, things are a little rocky. Can we work with this out? And they're like, no, screw the seller. That's what happens. That's why the banks start talking about it. And ultimately, there's just a lot of hot terminology working itself into this space that, I think it's fine to consider, but it's like, don't get hung up on the price. Just pay it, find a good business. Search funds, like traditional search fund investors will say, find a great business and be prepared to pay a lot for it. They do not care what they're paying. They'll pay whatever to get the great business. That's an extreme. Find a good business, pay a fair price, get SBA debt, and get the seller out of there. That's my advice. It's not going to be right for every deal. It's just how I like to do things.
Yeah, that's a great opinion. For those who don't know, because you said, working capital pegs, no one was really talking about that. Maybe walk through a little bit of what is a working capital peg for those that may not know, and how does that relate to what you just said?
Right. Well, if you're making the argument for a working capital peg, you're saying, well, you're not going to buy, an automobile without gas in the tank, right? But the way that, the Main Street market works is it's like you bring extra cash to put in because that's the seller's cash. It's a cashless, debtless transaction. It's an asset sale. That's how they stay out of the rules of the Securities and Exchange Commission. It all runs on asset sales, right? So you start an entity, they have an entity, and you buy the assets out and put them into your entity. That's the structure. But what happens is, when you're doing a $75 million deal at a 7x or whatever, yes, the working capital stays in there. This is a middle market business. There's going to be some amount of cash in inventory, in receivables, in payables, and in a minimum cash balance that needs to get balanced out so that that there's enough gas in the engine, so that there's enough cash, enough working capital staying in the machine. And the concept is that if you buy it and you're at a low part of the cycle, then you've got to come up with a bunch of cash that is going to increase your purchase price. The Main Street market has always worked as a debtless, cashless transaction. And now people are coming in and saying, hey, don't worry, here's my letter of intent. And, we're going to go ahead and calculate a working capital peg over time. And it's very vague what that's going to be. And then you will just owe me some money. And it's like, hey, man, you want to lose your deal? Do it like that. Do it like that. I also think that, a lot of people really like off-market deals. It's like off-market deals. Sure. But, the truth is like this is the Wild West. In other words, no one's really dialed in, and brokers, business, if a business seller is just going to like sell it to you because you call them like that, what do we say? People get hit by lightning, people, whatever, win the lottery. It's like, sure, it happens, like good luck, but it's very, very, very inefficient. And what I say is if you're not in this game, the odds that you're going to get an off-market deal are like approaching zero. It's when you're in the game and people know you're in the game that all of a sudden you get deals that are off market. So you got to get the flywheel going, and brokers have more deal flow than you ever will, right? And I'm not talking to you, Ryan. I mean, you're the maestro. You literally run the podcast. But anyway, like making billions is like just code for deal flow. But anyway, like the point is like don't try to advance your career in a game that you're not in yet. Like just get in the game, right? And so go to the brokers. By the way, the brokers more often than not have terrible SIMs. And so like if you actually do the work to learn about the business, then you now are the only one that can actually see the business anyway. So you just got deal flow at the seller's expense, okay? And now because you're spending the time to go in and do the work to figure out what's actually in the business, you're the only one that can see it, even though it's an on-market deal. It looks terrible to most people because most people in the space are fair weather buyers.
Yeah, true. So a brilliant breakdown of that, man, as always. Now, when it comes to now we financed the deal, we got the company, we've done all these things. Guess what? We're at the starting line. Holy crap, all that work just to start? Yeah, that's exactly right. So now we're on your marks, get set. And before the race pistol goes off and we dash out, that very moment, okay? So we funded the deal, got the deal. It's now our baby, this asset, whether we did a carve out or we bought the whole, either way, you got what you got. And now you're on the starting line. Let's take a different approach. But what's some conventional wisdom that's wrong at the start line now?
Yeah. So I think that the first time I bought a company, I didn't change anything for a year because it's like, don't change anything. It was always the sort of like buy a business and get a feel for it. Like you don't know what you're doing. Well, what I found was people were just doing dumb, inefficient shit. And like I wasn't fixing it because I was waiting my year. And now I've done this, 8 times over. And what I'm going to tell you is there's a little bit of a sweet spot where, when you try to change people's behavior, 12, 14, 18 months later, it's like, I've been doing this right in front of you for the whole time. Why are you trying to do this right now? And it's like, well, because your process is terrible. You're literally like writing specs on a piece of paper and handing it to Teresa or whatever. It's like, we don't need any of that. That's not what's happening here anymore. There's this sweet spot where when you buy a company, everybody, like we are nervous as buyers that like people, like everyone's just going to be like, what? And leave. Right. And what I would tell you is that almost 100% of the time, everyone stays unless they know the business is for sale beforehand. Okay. But when you walk in, you're like, guess what? The business, all they want to know is my salary the same? Are my benefits the same? They don't care about your speech. Okay. But like, really, like, that's what they're thinking about is like, what's going on with my salary right now? Because everyone that has a job is addicted to their paycheck like crack cocaine, and they need to get off the junk. Everybody does that's listening to this. Pro tip, get off the junk. Like that's how you do it. Okay. But so you have all these paycheck employees, and that's all they want to know. Right. So you got to tell them that right away. Right. But the thing is there's a period of time that's usually like month 3 through 6 or 7. everyone they really just want you to know that like they're on your team and that you can count on them and they're a good employee. And oh yeah, by the way, they probably deserve a raise. Everyone will hit you up for a raise. So there's all of that kind of stuff. And that's actually the most beautiful, magical time to go in and just start laying down like new processes and systems, right? So Ryan, will you share, like, I mean, you went in and did like process mapping and stuff, right? Like that's a perfect example. Remind us of that story.
Sure. Yeah. You can tell Walker and I have been exchanging war stories before we hit record. Yeah. So when I was brought in, it was fascinating. So my first clue, as I alluded to before, was there's phantom costs, right? So labor costs I felt was quite high. I did a gut check with the owners and I was like, does this feel a little bloated to you, your labor budget, or is this normal for your sector? Because holy crap, this seems like we're spending a lot. And typically, as any CFO or anybody that runs the number, you don't have to be a CFO, but anybody that kind of understands basic accounting says, why is labor so high? Like some industries really are really high, about 50, 60% labor costs. This was not one of them. And so you're saying, well, you keep hiring more people because the ones you got aren't doing the job in the first place. So you got 3 people trying to do the job of 1. And so we've got a productivity problem, likely some phantom costs. And so my first thing that I did when I came in to do that, and I would say, just from my opinion, this is a great thing to do when you first come into a company, is be like, all right, kind of pencils down. I need to understand, walk me through step by step, like I'm a 5-year-old with crayons, and I need to draw out every single step called a process map or a flow chart. I need to understand how we're doing it. Don't worry if it's any good or any bad. We'll get to that. But what I want to understand is, how do you do it? And when I found out, it was like, oh, we have to take a screenshot on this and then paste it in that and then move the file into Adobe and turn it into a PDF. So then it uploads into the system. And I was like, okay, stop. What?
Yes.
What is happening right now? And I'm like, wait, and everybody did it. They were doing this stuff at scale. And I'm not saying it's right or wrong, but what I am saying, it was wildly inefficient and very expensive, and it was hammering the bottom line of the business. And as the owner, you don't like to do that. So we built the process maps, and then we took a look at this thing, and I swear it was like a wallpaper that wrapped the walls of the boardroom, this whole process. And I was like, holy mother. So we looked at it and I was like, okay, how do we automate? And so the context that I did that in, and I don't think I shared this with you, so I follow something that I call SOS. I don't share this with a lot of people, but today I am. It's called stabilize, optimize, and then standardize, right? SOS. And so the first step is, I need to find out where the bleeding is so we can at least stabilize the patient, otherwise known as the company. Stabilization is step 1. And to your point, Walker, yeah, you're going to have to change some stuff.
Yeah.
And it may not be pretty and it may not be efficient. That's okay. You'll get to efficiency. Right now, the goal is stability. And then once we realized that, we're like, okay, maybe current state is stable. And in the story that specifically, it was stable. It was working. It was just wildly inefficient. So that's where you go to phase 2, is to say, okay, we're not bleeding, right? There's not stuff that's horrible and existential risks and all that. We're okay. Like we're barely making it by on a profit margin, if my memory's correct. But the issue is it's wildly inefficient. So we moved from stabilize to optimize really fast. And then when we went to optimization, that is now saying, okay, how do we do this faster, cheaper, and with less people? And boy, did that team come together, right? Under that guidance and under that direction, to say, great, I think you guys are doing an okay job. It's stable, but it's far from optimal. And that is showing up in productivity, which is ultimately a bloated labor cost. So then we optimized, and then standardize is just saying, okay, this is how things are done around here. This is it. And so we needed technology, we needed tools, we needed better process. So I cross-section, like you talked about your matrices, from SOS, we did people, process, and technology. So between SOS, cross-reference with people, process, technology, we were able to really clean up a lot of those phantom costs and really just process out just dumb things that people were doing. Smart people were doing things in a very dumb way. It wasn't mean that they were dumb. Just no one ever sat down and be like, all right, we're locking the door, we're eating a lot of Skittles, and we're not leaving until we have this process mapped out, which we did. And I think they were Slurpees. But either way, we really burned the midnight oil and we figured it out. And this is the kind of stuff they have now. I was there as an executive, so it's a little bit different concept, but the exercise is absolutely the same, that when you're owning a business, you got to explore that. And a big part is just saying, okay, where's the bleeding? If any, let's figure out the process. Walk me through customer service, how you do. Walk me through procure to pay or order to cash finance department. Walk me through onboarding of a new client sales department or brokers. And you build out this entire process map. And then you sit back, not just as an executive, But you sit back with all the leaders, even team lead, everybody, and just be like, I think your job sucks. Would you say your job sucks? And they're like, yeah, my job sucks. And I was like, I can see it. Nobody would want to do it like this. Of course your job sucks. And then you start cleaning it up and you give people a voice and people feel engaged. They feel that they have their fingerprints on the business. They're more apt to lean in and be part of the solution. And so I think really just figuring out what the heck is going on, filtering it through SOS, using people process technology as potential sources of solutions to inefficiencies. Now you're cooking with gas, right? So like you said, you're like, there's some financial stuff, but a lot of this is just frameworks. So thanks for listening to my frameworks.
Well, no, I love that. I took extensive notes just now. And I think I'd be interested, like the hardest part of all of that, in my experience, is when you go into these companies and you start having people write down exactly step by step what's happening, they're feeling their brain being exported. Like the value that I'm bringing is now being exported. And so they're feeling like you're trying to take something, right?
Yep.
And ultimately it takes a while. And the little thing that I try to instill is actually the underlying culture. And what I try to go with is sort of like, I didn't make this up. I wish I could claim it, but it's like, we're not placing, blame. We're just trying to find the root cause of like why this thing went wrong. Right. Like I don't care, like it's man method, machine material or whatever. Right. It's like, we're just trying to figure it out. Like it's like, and trying to help people understand that investing in, efficiencies and quality assurance or whatever you want to call it actually pays money is like the little thing that makes the big difference. And so, if we're talking about what to do, in the first 90 days or whatever, I mean, really focusing on that culture and trying to like give people a true north on, your values and where you're going and like how you treat people is really, really important. One of the companies I eventually sold, the guy came in and on day two, he's on the phone with my former, because I sold the company, number one supplier. And he's like, I'm not buying any of that shit. And the guy was like, well, and he was like, listen, the only person I listen to is God, and God isn't very happy with me right now. And I was just like, whoa, that's when I knew I was like, I need to get out of here. Because he's changing things beyond and treating people in a way that I don't. Let's just say his management style was very different from mine, right? And it's like, so get in there and do some changes, but it's my theory that he should not have changed that order. Now, look, maybe he's smart and I'm dumb, but when you go in and start like changing material core things in businesses, like that's a way where you actually screw up a business because you're getting in front of your skis because you think you're too smart. So, you got to, I love what you're doing. Focus on the processes and the people, because that's where you're going to find the wins, right? That's where you're going to be able to, one other thing, like 101, buying business for the first time. The number one mistake is you go in and you just increase your salary really high because like now you're the CEO and you just start burning all the cash that's coming in the door in terms of your salary. So what I like to say is there is an equity buildup happening. Your growth does look like this. It just is inside the thing, the capital stack, right? Give it time. Build safety, right? Eat ramen noodles if you can for a little while. Like just, you want cash. You're going to want cash in your business because if you run out of cash, the game's over and music stops.
Yeah, that's right. So thank you for that. So all of the conventional wisdom that you find to be wrong, and I agree with that. So before we wrap things up, this was, as always, it's absolute blast, hilarious. Those of you who can't see, half the time Walker's talking, I'm dying laughing, and I had to mute my mic. But we have a good time. We have a good time, as I hope you can feel, and you've joined us on such a great conversation, brother. As always, it's always good to talk to you. But before we wrap things up, man, you got so much stuff to do, and you got a lot of stuff going on. So final thoughts, any ways people can reach out to you, maybe get involved in some of the stuff you got going on? Like, give us a shout out, man. How do we get more Walker in our lives?
Yeah, well, what I would say is, free. I'm very active on LinkedIn. Feel free to reach out to me there as well. I've got a newsletter that I send out to 50,000 people every Sunday. It's, it's basically a book chapter. It's like 2,500 words every single week. I think you can get there through buythenbuild.com. You can definitely get there at walkerdeibel.com if you can spell my last name. But so that's free stuff. Buy Then Build is like $6 for an ebook. I'm not going to give it to you. You have to buy it, but it's $6. I think it's worth it. And, Acquisition Lab is, the elite, acquisition accelerator, acquisitionlab.com. Feel free to apply if this is something you want to do. We truly are a vetted community. About 70 to 75% of applicants are actually not invited to enroll. So just want to kind of set that up for people's expectations. And, if you're an accredited investor, go to buildwealth.com because we are bringing deals out all the time. Right now, we're actually rolling up 700 oil wells and we're doing a 14-acre rehab in downtown St. Louis. So some various menu of private assets there. So that's kind of the suite from free to give me $1 million.
Yeah. And everything in between. Yeah. Well, I appreciate that, man. So just to summarize everything that Walker and I spoke about, be careful of going horizontal. Maybe think about acquisition. If you're building a portfolio, think about vertical and how things are. Remember, we get rewarded for focus. The other thing that we talked about is just appreciate the opportunity of generations, not just yours, but many, is a lot of these businesses are coming online and they're up for grabs. And appreciate the frameworks. Don't do your first deal alone. Be careful of those phantom costs. Do SBA instead of seller financing. Don't do a deal too sharp of a pencil. A 3.2 and a 3.5x. It's silly. Just pay the thing. If it's a great company and you want it, don't lose a deal over 90 days earnings. And finally, just really dial in on operations. You can try SOS or any of those frameworks. You do these things and you too will be well on your way in your pursuit of making billions.